Good evening, everybody, and welcome to our masterclass this evening. As usual, it's such a delight to have you all. I can see a few people streaming in from the different platforms that we're streaming this masterclass from. If you're on YouTube, please let us know what you're looking forward to. If you have questions, indicate them on the comment section on YouTube. If you're streaming in from LinkedIn as well, super excited to hear about your comments and look at the questions that you already have. And if you're watching from KRA TV, Karibu Sana as well. We, again, are super delighted to have you join us. Now, if this is your first time interacting with us, HRBOX Africa, allow me to just spend 1 minute to brief you about who we are. So we're all about people solutions. That is HR software and HR services. So our mission is very simple. We exist solely for the purpose to empower your people to do excellent work. So if that is what you're all about, if that's what you're looking for, a partner to help you better manage your employees. So this, we're talking about all the way from payroll, leave management software, and HR services at large, then we are your partner. And we also have a community of HR professionals. One of the things we do here is professional development. And that's why today we are so excited to collaborate with Kenya Revenue Authority to take you through a masterclass that at least some of you have been asking for. So we are sure that this is going to be such an exciting session. We're looking forward to a presentation from the KRA team. I'm pretty sure we cannot possibly quite cover everything there is to when it comes to matters, payroll, tax, and compliance, but we have identified a few sections that at least we've gotten interest from you. So Nixon is going to be taking us through a session, and then after, like we promised, we'll have a live Q&A session. So feel free to let us know all the questions. We'll be looking out for the questions that you have in the different chat sections. So without further ado, allow me to introduce our main trainer for the day. I'm going to read his bio. So if you'll allow me, let me just read his bio and then I'll invite him. All right. So Nixon Omondi is a charter holder with CFA Institute, and he's a CPAK and completed advanced diploma in international taxation. He has worked with Kenya Revenue Authority in various offices in tax administration for over 15 years. So you are in good hands. And he's a trainer with the Kenya School of Revenue Administration and a member of the Task Force in the Digital Economy on OECD Working Group on Action 1, Taxation of the Digital Economy. He also holds a BSc degree in Biomedical Science and Technology and a master's degrees in Financial Services Management from the University of Salford, UK. Wow, what a bio. Nixon Omondi, Karibu Sana, we are super delighted to have you on board. Are you excited?
Definitely excited to be amongst my countrymen. Awesome. Always happy to be with the HR professionals. Thank you.
Awesome. You know, this is really not our first time interacting. We had a similar masterclass some time back. So we're super delighted. I can tell you for a fact that you guys are in for a treat. So without further ado, Nixon Omondi, over to you.
Thank you, Billy. And thanks to the great team, the great HR professional body. Today we are just going to discuss matters employment tax. I don't know whether we'll call it employer or employee, but we'll be learning together. And in addition to payroll taxes, we're also going to delve just a bit into withholding tax. Because as HR professionals, sometimes you get gigs, you get some consultancy work to do. So you need to know how to treat any other taxes that would be deducted from your business. So I'll go directly into the presentation. Feel free to use the chat box as I present to raise any question. And of course, at the end of this presentation, again, we'll have very good opportunity again to interact more through Q&A. We always give caution, and I'm happy my colleague Cynthia is here. If anything is not, you feel is not in consonance with the law, you can always raise it up so that we have a discussion around it. If you have a very specific question, you want to be guided legally, officially, we always encourage our taxpayers to write to our policy and tax division, which then advises and gives you a policy decision that can even stand in a court of law. So with that, allow me to get into the presentation. You know, people look at an HR person in different lenses. So just looking at my chart and my presentation, I want to see thumbs up for those who are able to do so, and tell me what they think and how people take them. Okay, that your friends who knows you are a HR professional thinks your work is just to fire people. When your mom, and for those who have moms, they think you're just enjoying and swimming in money. I think this might be true for some of us who have their parents in the village. And then the society out there, when you're walking along the streets, or for your friends or some people who think you knows you are a HR professional, basically think that society thinks that you don't do your job properly. You're just there. Okay, your employees, your supervisors, think we just sit and relax. And for those who are employers, they think as the CEO, you are just in meetings. You're not doing anything constructive. And what you think you do is hiring people, encouraging people. That is what you aspire to do as HR professional. But I know, especially for government officers, I don't know those who work in the private sector. When I come to your office, I find you with a pile of files. And I think the profession in HR is not any different from what I practice as a tax professional, as an accountant. And I'm happy already receiving a question from Gilbert. Okay. And I'm happy that some of those updates have been done on the P10. Super. And when the ITR option will be open, I think it's already open. You can actually file your returns. The IT1 return is now open with the SHIF and all those other levies. You can actually file your return. I think we'll have a conversation as we continue. So when we talk of pay as you earn, people think pay as you earn is a tax on its own. But pay as you earn is actually a method of deducting tax. You're imagining if all of us were to receive our salaries and then we remit the portion that belongs to tax, it will be a very difficult tax system to implement. So that is why, for ease of administration, of taxation of employment income, what the government has instituted as part of the law is that the payer of your salary is mandated to deduct and remit a portion of it. So that portion is what we refer to as pay as you earn. It is not a final tax in itself, because that is why at the end of the year, we as employees or employees under your care are then called upon to file their returns, but claim any pay as you earn that had been deducted at the time of payment of the salaries. So pay as you earn is actually a method of collecting tax from salaries, from wages, from stipends, from internship allowances, when you are in the process of generating income from office or from employment. When we talk of pay as you earn, it doesn't apply just to monthly salaries. If somebody is being paid weekly, he is being paid monthly. Some people are paid annual salaries. Some people are paid commissions. For directors in the house, you get directors' fees. Whether the person we are looking at is a resident or non-resident, which I'll explain a little bit later, that income is supposed to be subjected to pay as you earn. A portion of it is deducted and remitted as an advance tax to the government. When we talk of all cash emoluments and all payments which you receive on account of being an employee, all that should be taxable. So we are looking at what an employer gives you as cash. Sometimes an employer might even buy for you something. An employer might spend on your behalf, or you might be privileged to get certain benefits because of your position as an employee, a Christmas gift, a Christmas voucher, a vehicle, a house, okay, a medical benefit. Some employers are even more gracious. Employees get to eat at the workplace, of course, to avoid disruption about lunch and all that. All those, we call them emoluments, in form of wages, in form of salaries, in form of commissions, directors' fees, directors' bonuses. They are all subject to this regime where the employer deducts a portion, remits to the government, but later you are able to claim the portion that was given to the government. Now, coming quickly to the current situation, payee is deducted on the basis similar to taxation of individual income. So when you look at the way your payslip is taxed, it is exactly the same way somebody who has earned, okay, from business income as a sole trader is taxed, so long as that person is not under turnover tax rules, which maybe one day we'll explain. So if you are doing business and your turnover is more than 25 million, the profits coming out of that business, you are running a kiosk, you are running a consultancy firm, you are running a partnership, and you end up sharing the profits, your taxation regime is similar to somebody who is employed. And so the rates are one, so long as all of us are individuals. And that is what's stated in the law. The tax bands that we are using currently were effective from 1st of July 2023. And I'm happy that I'm speaking to HR professionals who love numbers. So we'll be dealing with the numbers in a bit. But there are also certain deductions that it's important to mention. There's the Social Health Insurance Fund, SHIF, where all employees are supposed to contribute 2.75% of gross salary, and the minimum is 300. Then we have NSSF, where employee contribution is 1080 monthly, and then the employer matches. But we'll explain more the 1080. The rate has since changed from February 2025. We'll have a more detail. We'll have more details. And then we have affordable housing levy that was brought in the month of March 2024 at 1.5% of gross salary, and the employer also matches a similar amount, and the contribution is 1.5% of gross salary. I think those are important. And then there are certain reliefs that are also available to employees, what we call a personal relief at 2,400, 28,800 every month. And these are the bands. So initially we used to have a 10%, a 15%, a 20, a 25, and a 30. But effective 1st July 2023, there are 5 bands of tax. The bands reflect the categories of people on wealth, whether you are on, the upper middle, upper lower, then you go to the lower middle. I don't know, there's a middle, and a lower. That kind of scenario is what was contemplated when the bands were arrived at. So you can see the table there: monthly bands, annual bands, and the rate of tax. And for those who are more blessed, the Bible tells us that for those who much is given, much is also expected. And it seems the government uses this same analogy. So if you are blessed and you are earning 500,000 up to 800,000, the government expects you to contribute now 32.5. If you are more blessed to be earning on a monthly basis over 800,000, the rate now goes up higher to 35%. And this is in line with the taxation principle as given to us by some great economists, Adam Smith and others, that a good tax system should be equitable so that those who have more income pay more tax, and those who have less pay less tax, and those who are earning below 24,000 don't pay any other tax, by the way. So that is exactly that tax principle. So just to drive the point home, I've worked an example of a person who has a gross salary of 50,000 and how that person is supposed to be taxed. So those who have seen the payroll systems, maybe you can feed this 50 and see whether your payroll system is calculating the tax properly. If your payroll system is not giving you payee of 5,845.65, which I've now rounded off to 5,846, then you might need to review that system. It's important also to use the rounding off. You're imagining TSC with the over 300,000 employees. If you only round off 1 shilling, it means at the end of the month, TSC might overpay or underpay by 300,000 shillings. And that is very significant. So rounding off to the 2 decimal points allowed. This is how tax is computed for somebody who is earning a gross salary of 50,000. Okay, we are saying all allowances, cash and non-cash, amount to 50,000. So we want to tax you. Your payslip and your employer told you you're not entitled to any other thing other than your salary of 50,000. So if you're earning a salary of 50,000 in a month, and these are monthly rates, the first thing that happens, you work on your gross pay. Just to go to the seemingly second table where we have pay information. So under pay information, your gross pay is 50,000, but effective December 1st, 2024, with the amendments that came with the Tax Law Amendment Act, there are certain contributions that have been given as allowable deductions. So before you are taxed, the amount is reduced to what we call taxable pay by those figures. Okay? So we deduct 5,124. How do we arrive at 5,124? We look at how much NSSF are you contributing. Later, I'll take you through NSSF, how to calculate it. But a person who wants 50,000 will pay tier 1 NSSF for 480, and will also pay tier 2 NSSF of 2,520, giving you a total of that should be 3,000 in total. Okay. Then after that, we also have shift, which we had explained, 2.75% of your 50,000. You see 1375, and then you have the affordable housing levy of 1.5%, which gives you 750. So 1.5% of 50 is 750, and then 2.75% of 50 gives you 1375. So it reduces how much you are supposed to pay, and once those figures are reduced, okay, Oh, thank you. Daniel Wahome is already asking a question whether the bans were declared unconstitutional. Wahome, the High Court, yes, said that the Finance Act of 2023 was unconstitutional, but there was a stay. Then the Court of Appeal finally ruled that there was nothing unconstitutional in the Finance Act of 2023, and therefore it is fully operational. So there is nothing unless contrary, except the Affordable Housing Levy, which was brought in the Employment Act, in the Finance Act of 2023. That's the only one that was declared unconstitutional, but later it came in its own act under the Affordable Housing Levy Act. So, Daniel, it is fully constitutional. So once you have your taxable pay at 44,875, you move it to the tax table just below, and then you compute how much tax should this person pay. So it means these deductions gives you a breather in terms of how much tax you are going to pay. If these deductions were not available, definitely you'll pay a higher tax because you will not have the allowable deductions of 5,125. You'll be taxed on the gross of 50. So how we do the tax is, that is how the law is structured under the first schedule to the Income Tax Act. 24,000 is taxed at 10%, which gives you 2,400. If you only have 24,000 as your income, you'll be taxed at 10%, gives you 2,400. But there's usually a relief you're given of 2,400, 28,800 in a year. So that is why those who earn 24,000 and below do not pay any tax, because even if they were to pay, the effective tax will be zero. They will pay 2,400 minus the relief that takes us to zero. But this person is earning 50,000. So after removing the first 24,000, deducting it, he still has some income to be taxed at a higher band. So the next band, you can see from this table, is between 24,000 to 32,333 monthly. So if you deduct 32,333 from 24,000, you don't deduct 24,001. This is part of what we did in statistics in high school. So if you deduct 24 from 32,333, you end up with 8,333. So that next band, which is 8,000, is taxed at 25%. And you see 2,083. There's a bit of rounding off that I've done. So the balance is 12,542 because you are removing or you are deducting from 44,875. You've already taxed the first 24. You've taxed the next 8,000. It means you have a 12,000 balance. But when you go back to these bands, the next band starts at 32,333 up to 500. That is well over 467,000, which is taxed at 30%. So what it means, we have amount available to be taxed at 30%, which is 3,763. Then you add the totals, 2,400 plus 2,083 plus 763, you get the gross tax payable, which is 8,246. Then you deduct the personal relief, 2,400. You get the net tax payable, which is 5,846. And as a HR person, when you're now doing the payroll or the pay slip of this employee who is earning 50, we go back to the opening of our table. So this person has a gross pay of 50,000. His pay is 5,846. He is paying NSSF Tier 1, Tier 2. Total is 3,000. He's paying SHIF at 1,375. He's paying housing levy 750. Some employers are gracious enough, they might give you an advance. So that advance will appear here. Okay, they might pay for you school fee. It might appear here if it's to be deducted from your salary, and then you have total deductions, 10,000, and the net pay of this employee is 39,029. Daniel, you're asking a very good question. Taxation of SACCO directors, commissions, and emoluments. Which band does this fall, and what rate is applicable given this is secondary source of income? Good. Let me pack that and deal with people who are now more blessed, who should be giving us much more. So when you look at the next, this is now a person who is earning 1 million. And by the way, it's not a surprise to earn 1 million in Kenya. Some of us in civil service might feel 1 million, okay? But in the private sector, it's possible. So this person earns gross pay of 1 million. It means this person is going to pay NSSF tier 1 and 2, is going to pay SHIF and housing levy. So the deductions will be 480, that is the maximum for tier 1, and NSSF, the balance will be 6% of, there's a calculation which I'll show you, there's 3840. We are dealing with this year. So this person is already paying 4260 as NSSF contributions. And then the SHIF, which we agreed is 2.75% of 1 million, which is 27,500. And then the housing levy 1.5% of 1 million, which is 15,000. So when you go to the second portion of the table, there's the pay information. Gross pay is 1 million. Allowable deductions, which is NSSF, SHIF, and housing levy, is giving us 46,820. So what is supposed to be taxed is 953,180. Now, when you go to taxing the 953,180, you see the first band, same as what we looked at when dealing with a 50,000 person. The next, same, 25%. But now we have enough to take this person to band 3 and 4. So this person can be in 30%, he can be in 32.5, he can also be in 35. So what we are doing is, the next band is 467,667 at 30%. He still has a lot, he can still get to the 32.5, which is 300, because the band starts from 500 to 800. So the difference in that band is 300, so you can still get that tax. Then when you add all that and minus from 953,180, you still have a balance of 153,180 to be taxed at 35%. So when you add all the taxes, it gives you 295,896. You give a relief of 2,500, and the net tax payable is 293,496. So those who are in charge of payroll, if somebody is being paid 1 million without any other reliefs, other deductions, other than this generic, which I'm demonstrating, the payee is 293,496. That is equivalent to almost 30%. Okay, so that is the process of calculation of pay as you earn. I think that is what I wanted to bring out, just to try and demonstrate how we tax. But nowadays, it's very easy. There are a lot of online tools. You feed the income, the gross pay. You can go for annual rates. You can look at monthly rates. You can also cross-check with your accounting system whether the accounting system or the payroll system is calculating the tax properly. Feel free to even reach out to myself, the HR professionals team, Pili here. We can always relook at your system if it's not calculating properly, just to ensure that systems are calibrated as the law will require. So allow me to now go pick NSSF, affordable housing, and SHIF, just for a little much more explanation. So from 1st February 2025, we are contributing what is in line with phase 3 of the implementation of the NSSF Act of 2013. Most of you will remember that initially there was a court issue with this implementation, but that was then lifted upon appeal. And therefore, NSSF is implementing the first implementation as contemplated in the Act. So effective last year, the lower limit was from February this year. The lower limit, which used to operate at 7,000, has gone to 8,000. And then the maximum contribution has risen from 420 to 480. That's why you are seeing we are using 480. And then the upper limit, which is tier 2, has been increased from 36 to 72. And the contribution is now 6%. So what used to happen is, if you're earning 50,000, for example, before February 2025, your upper limit will be 7,000. At 6%, you get 420. Then if you're earning 50,000, the upper limit is achieved by calculating 50,000 minus 7,000, and then it is multiplied by 6%. So that gives you the upper limit, which we had determined earlier to be 3,006, is it 3580 or thereabout, or 3680. So you add the two and you get the amount you're supposed to pay. But the limits have now been increased so that you now pay 6% of the upper limit, which is 8,000. That gives you 480. And then the balance of your gross pay minus 8,000 is then multiplied by a 6% to get the upper limit. So the maximum contribution has actually gone up from 2160 to 3840. So when you are looking at the upper limit, for example, this person who is earning 1 million, the lower limit will be 6% of 8,000, which is 480. You are able to see it demonstrated here. Then the lower limit will be 1 million minus 8,000, which is 919, is it 999 and something? And it should be 992,000. Then minus 8,000. Okay, I've already minus, so that's 992,000 times 6%. You'll find it's actually more than 3840. So this gives you the maximum, meaning the maximum is 3840 at whatever salary, and that's why you end up with 4320. I'm told that the rate might also go up next year. I don't know whether it's going to 9,000 and then we are going to 144,000, but we'll wait to get communication from that. But remember, it is still the implementation of the act as it is. And the other day I was seeing that somebody was trying to calculate with the old NSSF of 200, if you had worked for 30 years, how much you'll get as your pension. And with the new rates, how much you'll get as your pension. And what I saw, I'm not watching for NSSF, what I saw is that the differences are so huge. And I think maybe we'll come to appreciate upon retirement. For those of us who are facing retirement soon, maybe it might be something to consider to put more upon our retirement. We have tax refund for employees. Our law allows us to refund employees for any tax that is overpaid or paid in error. That is under the Tax Procedures Act. When you look at that Tax Procedures Act, you are allowed to claim any excess tax paid or tax paid. It may arise due to many reasons. Okay. One, if you are over-deducted by an employee, and it might be because of a system issue, or it might be by mistake or something like that, you're always allowed to apply for your refund. Or there is a tax incentive. Currently, I know the SHIF, which is insurance, is a deductible amount against your taxable salary. But the ordinary traditional insurance premium is still given as a relief. 15% of your monthly or annual premium, subject to a limit of 60,000. There's also the annual tax relief, okay, if it's available. Exemptions on account of disability. So anybody who is employed within the HR profession or within our care, please advise them to seek exemption certificate. Of course, the process is handled squarely by the council, the council for people who are abled differently. They handle all the processes, including vetting. They only forward us the applications for processing, which of course we do through iTax. And once somebody has an exemption certificate, they are allowed to withdraw up to 150,000 in salaries without being taxed. Okay, and then you have overpayment of installment taxes. This is for individuals. For people, you and me can have side hustles, and if you've paid any installment tax, then definitely you are within your rights to request for your overpaid tax. Withholding tax can appear. Advance tax credits can also be there. You paid tax in advance. There are also people who have motor vehicles commercial, heavy vehicle, or heavy motor vehicle for cargo, or PSVs, please, you need to declare the income. You also need to pay advance tax. If you have a pickup, which is a commercial vehicle, single carrier, single cab, just know that it's a commercial vehicle subject to advance tax, and that can also give rise to taxes, excess tax, which then you need to apply for your refund. Let me address Dan's question. SACCO directors, commissions, and emoluments, which band does it fall? Good. If a director is also an employee in the SACCO, okay, then that is very different because he'll be taxed like any other employee. But if a director is being paid an allowance, and it's good, it's somewhere, we'll discuss it sometimes later. It's in this presentation. The payer, the SACCO, for example, needs to ask the director, is this your secondary employment? And if it is their secondary employment, in their primary employment, are they above 32.5% taxation? If they are, then the secondary employer will apply that top rate tax on the commission and emoluments. So if, for example, Nixon is also a director of Ushuru SACCO. Ushuru SACCO is the SACCO for KRA employees and many others. If I'm also a director, KRA already pays me, let's say KRA is paying me 200,000, okay? It means if I'm a director on the other side, and therefore I'll not be required, I cannot be taxed by the SACCO at a higher rate than what I'm already paying. I'm within 30. So I'll be subject to 30%. And then if there's any kind of excess, I'm eligible to claim the refund. But it will be quite, I don't know whether to say unfair, if a secondary employer taxes you at a rate which is quite higher than what you are supposed to be subjected to. For example, you're within 30 and your tax at 35. Fair enough, still, you'll file your return and then you'll be able to get a refund for your taxes. And Joseph, thank you. Your comment is noticed. We'll try to save time and answer the questions later. But I'm happy there are also people in the team who are answering those questions. So when you want to apply for your refund, and please, this is a notion to many employees, that the moment they file their income tax returns, what we call IT1 returns for individuals, and they see a negative, they just know that KRA is going to wire the money to their accounts. No. The law requires you specifically to go into the KRA tab under refunds menu and follow the procedure to apply for your refund. The good thing, the moment your return shows a credit, meaning you are in refund, when you go to the refunds tab, you can quickly pick it up and apply for the refund. Number two, make sure that your bank account is well captured, because that is the account where once the refund is processed, money will be sent to. Upload supporting documents. I've seen many cases of colleagues and friends who just apply for refund, but they are not sure what caused the refund. If it is because of insurance relief, if it is because you are overtaxed by the employer, if it's because of a disability certificate, exemption certificate that you did not take to employer to give you the exemption, and any other cause, make sure you attach the necessary documentation so that our refunds officers will not come back to you to ask for those documents. Definitely they'll still come. The law requires them to process the refunds within a certain time frame. So they'll still come back to you and ask you for supporting documents. And they give you maybe 30 days. If you don't provide, the refund is automatically rejected. So it's always important when you're applying for your refund, attach the necessary documents, speak to professionals, speak to KRA and tell them, I'm seeing I'm filing a negative. Is it because of an error from my employer? Is it because of SHIF? Is it because of NHIF, NSSF? Is it because of an insurance? Is it because of a mortgage relief? So that you attach the necessary documents for officers, of course, to process that refund. Make sure you apply for your refunds within the required time frame. The Tax Law Amendment, Tax Procedures Amendment Act of 2024 now gives us 5 years. So you only have 5 years to claim your refund. So if you go back to your ledger and realize that in 2018, yes, you had a refund which you did not apply for, then the law bars you. It's not KRA that refuses your refund. It's actually the law which bars you from claiming that kind of refunds. Then we have a tax amnesty now going on. I know many employees, many people either filed late, failed to file, or have side hustles that they never declared. The law allows you under our Tax Procedures Act that you can apply for your amnesty. We barely have 3 months to go. By end of June 2025, you'll be eligible to apply for the amnesty. And if it is just non-filing penalties, up to December 2023, it will be automatically resolved. You will simply find an email telling you that your amnesty has been processed. So don't fear. I know people get such messages and start wondering, which return is this? What is wrong? It's only that the system has realized you had a penalty or an interest, but you did pay the principal tax, you filed the return, and so the penalty is automatically waived. But if you have any outstanding tax, or you did not pay any tax, then the law or guidance from KRA is such that you need to pay the principal tax. If you cannot pay it once, then you can enter into a payment agreement with our office, then it will be waived automatically. But you have to clear the payments by 30th June 2025. So debts arising from 21st January 2024 are not covered in the amnesty. So those ones you'll have to pay fully. If you have a dispute ongoing, we ask you that please approach ADR if the issue is not so weighty. If you wish not to visit the judicial offices, go through ADR, then you take advantage of the amnesty when the time is there. So that has been our rallying call, okay? But if you're under audit which is ongoing, you're under investigation which is ongoing, until the audit or the investigations are concluded, you cannot claim this amnesty. So maybe it might be a chance to quicken those audits. If you know in your office there's a KRA audit, compliance check, investigations going on, maybe you could facilitate the officers to quicken the audit so that if you agree on the taxes to be paid, then you have an opportunity to claim to claim the amnesty so that penalties and interest is completely waived. Payee, as I've already said, is paid by 9th of the following month. Failure to deduct payee, there's a very heavy principle, sorry for the typo. There's a penalty of 25% and 10%, 10,000, whichever is greater. So imagine you're looking at an employer who pays 1 million as pay as you earn on all the employees. If in any month you fail to deduct payee and account for it, there's a 25% penalty, which is 250,000 or 10,000. So you'll end up paying 250,000. If you don't file a return in time, there's also 5% late filing or non-filing, or 10%, whichever is higher. So the penalties are very huge. But of course, there's also a penalty for withholding tax. There's a 10%, maximum 1 million. I think this has also been dealt with in the Tax Procedures Act. I think we'll explain that shortly. I also wish to highlight on retirement benefits taxation. This has also come up in the recent amendments that happened on 27th of December. One, KRA no longer registered any retirement benefits scheme. When we talk of a retirement benefit scheme, we are looking at a pension fund, we are looking at a provident fund, we are looking at an individual retirement fund, an umbrella fund, and all those funds, provided they are registered by the Retirement Benefits Authority. So what has happened in the new dispensation is that any retirement benefit scheme has to be registered with Retirement Benefits Authority. Once it is registered, even in the Income Tax Act, we deem that that scheme is registered. And once it's registered, employees get a deduction, which we explained earlier, similar to what we see in NSSF. But in addition to NSSF, which is a statutory pension scheme, people also go for occupational schemes. They have their own pension schemes, like KRA pension scheme. People go for umbrella schemes with insurance companies or some banks, okay, or individual retirement schemes with insurance companies. So if you are contributing to those individual retirement schemes, the law allows that before you are taxed, just as we saw in the example with NSSF, the taxable pay is reduced by the actual contribution, 30% of your pensionable income, or their maximum, which used to be 20,000, and now from December, it has been increased to 360,000 per year, which is 30,000 per month. So in the example that we saw earlier, if, for example, in this example, sorry, I hope it's visible. If we take the 50,000 person, if this person is paying NSSF of 3,000, and the person is also paying, contributing to a pension scheme of 5,000, and the employer maybe matches, the contribution made by the employee will reduce the taxable pay. So in that case, instead of 44,875, if the employee is contributing a further 5,000, then the rate will come down, okay? To the taxable pay will come down to 39,875. So effectively, the overall tax also comes down, because we know pension is actually your money that is being kept for you. So that 5,000 is what is allowable, but you can also calculate 30% of pensionable pay, which will be 30% of 50. That will be quite high, 15. The law looks at the lower actual contribution, 30% of pensionable pay, or the maximum, which is 20, or currently we are dealing with 30,000. I think I'll explain what it means, the 30,000 and the 20, just shortly. So the maximum amount is available for both employer and employee, but the employee contribution takes precedence. If you are contributing to a non-resident scheme, I know some Kenyans might like the pension scheme in Panama, the pension scheme in Bermuda, the pension scheme in British Virgin Islands and all that. Those deductions will not be allowed. The scheme has to be regulated by RBA, registered and domiciled in Kenya. And because you'll be contributing, there are certain benefits when you finally retire. So I don't want to dwell on these benefits because we are dealing more with payroll. But for a pension scheme paying retirees, there are exemptions when they are giving lump sum. There are also exemptions when it is monthly. But I'll also explain something on that shortly. Then, if an employer is contributing on behalf of an employee, so long as the amount does not exceed 30,000 per month, employee and employer combined, then it is not a benefit to the employee. So if Nixon is earning 100,000 and KRA is contributing 10%, and Nixon is also required to contribute 10%, it means the total contribution will be 20, which is within the maximum limit, which is 30,000. So you'll get a full deduction of 20,000, of 10,000, which I contribute as an employee, but the amount the employer contributes will not be a benefit. It will be unallowable deductions. As the employer is filing their income tax returns, they'll be allowed to claim how much they are paying on behalf of Nixon as an expenditure. So their taxable income also goes down. Okay? Then for gratuities, because I know the employers who don't pay pension, employees are on contract. The employees, upon expiry of their contracts, they are allowed to transfer up to 360,000 every year of their contract to a pension scheme without them being taxed. So if Nixon, for example, is working for KRA and is on contract, and he has been told for every year of your contract, once your contract expires in 5 years, we will pay you 1 million. Of course, that is my wish. We'll pay you 1 million per year of service. Then it means by the end of the 5th year, I'm supposed to be paid 5 million. The law allows me to move 360,000 per year times 5. That will be close to 1.8 million into a pension scheme without being taxed. So the balance of 3.2 is what will be subjected to pay as you earn. So that means you lower your taxes, you increase your future pension money, okay? But again, the rule for employers, if you have employees on contract, please don't pay them this money and they tell you we have transferred it to a pension scheme. Our administrative processes require that the employer transfers that money directly to the pension scheme for the employee to enjoy the 360,000 annual gratuity, which is not taxable. But remember, the 360 should be taking even care of the statutory NSSF. So you actually have a smaller window. It might be 300 and something thousand, not the full 360. In 2016, the government saw it better to remove taxation of pension income from employees who are senior citizens. Those are 65 years and above. Initially, it was for both lump sum and monthly, but again, after review, because of certain abuse, the law was amended so that only periodic monthly pension income was exempt. Thanks to the Tax Law Amendment Act of 2024, if you are retiring now, for those who are retiring from December 1, if they are retiring because the pension scheme has dictated retirement age, if your pension scheme or provident fund detects the retirement age at, let's say, 60, like for government employees, and you are retiring, your pension is now supposed to be paid free of tax. If it is a retirement annuity, same. If you are withdrawing because of ill health, you might be withdrawing at 40, at 50, but you've been a member of the scheme, your pension or provident is also paid free of tax. And when we talk of ill health, we also mean death. We also mean maybe infirmity of any part of your body that incapacitates someone that cannot work. So I think as HR professionals, this will be a good gospel to tell our employees so that anybody who is retiring after the promulgation of these laws can take their pensions, provident funds without being taxed. Of course, there's also 20 years of being a member. And some of us who have served for long, as Pili read before, we are waiting for just a few years so that when we retire, we can have all our pension we can withdraw our pension money tax-free because we have served for at least 20 years. The law allows you to move funds. So if an employer is moving from company A to company B, you can move those funds without them being taxed. Okay, the law allows portability of funds so that they are not, because they're just moving it from one retirement benefit scheme to another retirement benefit schemes. If unfortunately an employee dies, the law allows that benefits, death benefits are paid free of tax up to 1.4 million. And that 1.4 million is in totality, not looking at each beneficiary, but all the beneficiaries combined. Then we have taxation of gratuities and lump sum payments. I think this one is always coming up because many employers are putting employees under contract, and upon the end of that contract, employees are paid, and therefore it is important to determine how do we tax that lump sum payment. Lump sum payment, just as normal payee, is taxed on accrual, but there's a special provision under payee section 5 where if the income is going to be accrued prior to 5 years, then we lump all that income in year 5 and tax it. So what happens is, if Nixon today is being paid lump sum or gratuity for having worked 5 years, the law deems that that 1 million has been accumulated or accrued over 5-year period. Okay, so over each year based on your payment on your last salary. So we accrue it backwards for 4 years, and then the balance is taxed in the 5th year. I think with an example it will be very clearer. So you can see this an example of somebody who received a service gratuity, he received a notice pay, and he also received some service pay, gratuity, whichever name we want to call it. So what you do is you look at the last year of service, the number of years of service, and how much the person has received. So you see the person has received 609,280. So you're supposed to spread back 609 for the 33 years this person was in service. So if you divide it that way, you find each year of service, the person is supposed to be paid around 18,000. But the law tells us that we spread it backwards, but tax any residual in the 5th year. So we'll take 18,000 for the corresponding year, retirement year 2023, year 2, year 3, year 4 have put 2 because in 2020 we had 2 rates of tax. There was a 25% and a 30%. I know there are complications around that. Then the last year we lump the whole balance and tax it. If the tax rate has not been changing, then even if you tax it in 1 year, it doesn't show any difference. But if the tax rates have been changing, then you need to spread it so that you tax it accordingly in its respective year. For example, 32.5 and 35 came in 2023. So this person, you need to spread it so that the taxation is fair in each year of service as required. That is how we spread some of these lump sum payments. Now, I want to take you through emerging issues. Once we go through emerging issues, then I can take you through a bit of withholding tax. From there, we can pick questions, comments, and then we hope we'll manage that within the next 30 minutes. Somebody had asked about board members, a very recent case, a 2024 case. There was a case very close to where I come from, Uriri constituency, that's the CDF, and usually there's a CDF board. So the board members were being paid allowances, and what the care officials had visited the board and said, no, these committee allowances are subject to payee. And the board felt, no, the committee allowances are not supposed to subject to payee. Actually, I don't know what they were understanding as the allowances. So the Tax Appeals Tribunal has ruled that committee allowances and sitting allowances of public bodies, and this will also extend even to private bodies, are subject to pay as you earn. So it's important as a HR professional, when you have board members, just take care that whatever allowances they are paid is subjected to pay in respect to what my colleague Ali had asked. I think he had asked a question on board members being taxed pay at the top rate, or you need to determine whether that is a secondary employment, and then you tax them appropriately so that you don't overtax them. But the good thing is, even if you overtax them, when they file the annual returns, they're able to claim any credit. If it gives rise to a refund, they can apply for their refunds. One of the biggest questions I think that I'm meeting currently, and I'll say this without fear of contradiction, after the entry of SHIF, after the entry of the new NSSF rates, after the entry of affordable housing levy, I know many employers, and I've audited some of them, who have decided to rebrand their employees as consultants. My advice has been, you are putting those employees in a tight corner because you are deducting 5%. When the employee files their return, two issues will come up. Remember, Section 16(2)(c) now requires that you cannot claim a tax unless an expenditure unless the expenditure is supported by an ETIMS receipt. So it means if you change your employees from employees to consultants, they must give you ETIMS invoices, or else we will gross up the withholding tax and require them to pay the top up. And most of us as employees, you get your money, you pay your bills. If somebody is being paid 100,000 per month, it means at the end of the year, that person shall have been paid 1,200,000. If you put that person as a consultant, you shall have just deducted 5% of 1.2, which I think is 60,000. So this employee will be having income of 1.2 million, which is now not salaries, but business income. We'll ask the employee, which expenses did you incur? They can always manufacture, but the next question will be, if you incurred these expenses, give me ETIMS invoices, valid invoices. And that is where the rubber meets the road. So most of those employees will not be able to substantiate that. What does that mean? The employee will be required to pay up to 30% of 1.2 million. 30% of 1.2 million, I'm looking at 420, minus the withholding tax of 60, you're looking at 360,000. Where does an employee get 360,000 to pay? So I think it's important to look at this thing with a better lens, 360 degrees, so that if somebody is a consultant, treat them as a consultant within the realm of the act. If somebody is an employee, treat them as an employee, be in consonance with Section 5 and the pay guidelines with respect to taxation. And in a very interesting case of Everett Aviation versus KRA, you can see what the court decided to be who an employee is. The person's duties must be integral, part of the employer's business. The person must be in control and integration of the employer. You know, I've handled a case where somebody tells you he's a consultant, but when you go to the consultant agreement, you find the agreement saying that the consultant will get into the office at 8 and leave at 5. You will have 30 leave days. A consultant cannot be controlled, cannot have leave days, cannot be paid when he raises an invoice. But for an employee, we expect monthly payments in line with the Employment Act. Okay, obligations to work only for that employer. You might have to sign a non-compete non-compete agreements, hours. There is even overtime bonus. Holidays are specified. Arrangement of income tax. Sometimes they are paid for an SSF, and then the employer says, "This is a consultant." Okay, how is the contract terminated? Okay, whether the individual may delegate work. Okay, whether the person provided tools and equipment. So I think it's important to look at all these indices to check whether whoever is working with us is really an employee, what we call de facto employee, or it is just branded as a consultant. Because again, if KRA visits and find that issue, definitely they will require you to account for pay as you earn in line with Section 37. Then we also have other issues like non-inclusion of taxable benefits. You find employees being given airtime. Some have motor vehicle, whether they are sales staff, and they are able to keep those vehicles during the weekend. There's no logs kept. Housing, they have been housed. School fees paid for some employees, and these are not put as part of benefits. I think those are some of the non-compliance issues that might arise. Then a very interesting topic, and HR professionals, I know you deal with this every day. An employee has been taken to court, or there's an accident and there's a waiver. The court is pronouncing itself and saying you caused the employee emotional distress. There was defamation where you decided to go to a national newspaper with wide circulation and say the person whose photo appears here is no longer allowed to transact business on behalf of. and that person takes you to court for defamation, humiliation, discrimination, physical injuries, sometimes even impunitive awards that courts can give. The issue has been, are those payments subject to pay? And of course, my answer, which is very subjective, will be no for the ones that I've mentioned. But there are cases where an employee takes you to court for wrongful discharge or dismissal, failure to honor contract obligations, so they need compensation for economic loss, such as lost wages, they lost business income, they lost some benefits, they want dismissal pay, they want severance pay, or they want payments in involuntary termination. Those ones from a top level, I think the devil might be in the details, they are subject to pay as you earn. So it's important to check at what lawsuits provide, or even accidents, and how they are compensated, what is entailed in those compensations, so that you know what is subject to pay as you earn and what is not subject to pay as you earn. There's an issue of remote working. It appeared in our the Tax Procedures Amendment Act 2024. Now, if anybody resident is working for a non-resident person, the law requires that the non-resident should onboard the PIN and have registration for that employee. We have employees who are working abroad. We have people who are engaging employees who are non-resident. I think those are very important considerations to take into account. Now, if you have employees who are working abroad, and this is a very common question, and as HR people, you know it will come to you. Nixon has gotten a job in Nigeria. How do you tax me? Is that income taxable in Kenya? Look at what our law provides. That an amount paid to one, a person who is or was at the time of employment, or when the services were rendered, a resident in Kenya, okay, then any payment the person receives for employment or services rendered are actually taxable in Kenya. So it's important again to look at who is a resident person. So if a person is a resident, they have to be taxed in Kenya. If it's a non-resident person, of course, I did not get into details of who is a resident, but if the person is a non-resident, you only tax the person in Kenya if the employer is resident or employer has what we call a permanent, as a fixed base in Kenya. Where a double tax agreement exists, Kenya has 15 double tax agreements: India, Italy, Germany, Sweden, Zambia, South Africa, UAE, I think Qatar, and all those other countries, France. The employee is deemed to be taxable where employment services is being exercised. And employment services, because the laws are very traditional, it's deemed to be exercised where the employee is physically present. And I think if an issue arises of an employee who is a resident of Germany or a Kenyan working in Germany, it is always important to consult the double taxation agreement, Article 15 of our double tax agreement with Germany. So that is also important to take into account. Another issue has come in, very interesting case, Civicon Limited versus KRA. So Civicon secures a contract in South Sudan with the WFP, World Food Program. They are doing roads in South Sudan. One of the rules from WFP to Civicon is you must engage Sudanese citizens. So of course, Civicon on board Sudanese citizens who are also taxed according to South Sudan revenue rules. But our guy said, because Civicon is resident in Kenya, and we are able to see payments going to some employees in South Sudan. So our issue was, is this not income subject to pay based on Section 5B? A resident who is paid, non-residents who are paid by a resident company in Kenya. But I think the Tax Appeals Tribunal guided that pay was not payable because, one, the funding came from WFP, which, Civicon was just acting as a conduit. And again, those employees were actually exercising their employment services while in Sudan, and therefore we were not supposed to tax them. A very interesting case, because if you look at the court's position, on the funding coming from WFP. What if Civicon are the ones who are funding the payment of the employment services? Maybe a different discussion. But always, as I mentioned in the beginning, if you have any technical or complex issue, you can always reach out to our tax and policy advisory division to guide you on some of these tax matters. Withholding tax upon payment of certain services. So this is very critical. If you're paying a resident or a non-resident on certain payments, then the law requires you to do a withholding tax. It can be final or an advance tax. Final means once you withhold a portion and remit to commissioner, there's no further taxation. Advance means there's a withholding tax, but it's not final. Therefore, the person will declare their full income, but take advantage or take credit of the tax that was withheld. The issue of paid has been debated enough. Paid doesn't mean actual payment. Even when you just debit the entry or credit the entry, the law deems that you have made payment and therefore withholding tax is basically due. Some of the payments that are subject to withholding include management, professional training fee. So as a HR people, if you take your people for training, you've invited KESRA, you've invited PwC, you've invited ABC training, or even your association, and you are paying them training fees, the law requires you to withhold a 5% if the trainer is resident. Or even if you invite Nixon to come and train, there's a 5%, of course, within our laws. If you invite a non-resident to train, you are dealing with IHR, who is coming to train your people, okay, and maybe they're coming from London, then there's a withholding tax of 12.5. So you need to take into consideration. So there's consultancy, legal fee, you are paying lawyers, you are paying accountants, you are paying auditors, you are paying contractual fee, you are building, you are paying architect, you are paying, all kind of professions. Then you have winnings. This is for betting companies. Then there are also people like, was it last week when we had a very good gig in Kenya, or the week before? You bring in an unresident to come and entertain your people. And I know HR people, you want to motivate staff. December, you might decide to invite Kofi Olomide to come and perform in your end year party. The law requires that if you are the promoter of that person, you must collect a withholding tax from that entertainer. But if the person is resident, you invite some of our local artists, there's no withholding tax. Then royalties, interest and deemed interest, dividends. I know many SACCOs are now paying dividends. You'll find that you get your dividend minus a 5%. That 5% is the withholding tax. If you fail to withhold tax, okay, there's a penalty of 5% and an interest of late payment of 1%. So it's important to look at that. Withholding tax is paid within 5 days upon making the payment. So the moment you are crediting or debiting that transaction, within 5 days, the law requires you to remit the withholding tax. Of course, nowadays, once you remit, a withholding tax certificate is automatically generated. If it's not a final tax, the certificate goes to the other person so that they are able to claim the credit when they file their final return. But if it's a final tax, you will not see any credit. You will not see any withholding tax certificate because it is final. Like most of us who get some dividends from SACCOs. I think that should be all from me. Back to you, Pili. We can now pick up Q&A, and then we can progress in that manner. Thank you.
Yes, so we have a bit of time left, so we'll go through some of the questions that we've asked. And I want to start with the LinkedIn people. So I see Caroline here has asked, do you have to apply for the amnesty, or if you pay for the principal amount, the system will automatically clear penalties? You're muted, Nixon.
Sorry, Pili. In my presentation, I've attached step-by-step guideline on how to claim the amnesty, especially if you have a tax owing. So people can go through that. but everything is done on iTax. So what you need to do, you file your return or go to go to the amnesty tab. There's an amnesty tab. Once you go to the amnesty tab, it will give you a window where you select the principal tax and all the penalties. Then immediately you are done with it upon submission, it will generate for you an amnesty certificate, okay, showing that you have applied for it. You go back to generate a payment receipt number or certificate. It will bring you to just pay the principal tax. You'll actually find that the penalties and interest does not get populated as you pay for the amnesty. So that is the application process. Now, if you are not able to pay the principal tax in total at once, that is when you'll need to do a payment plan to the commissioner. So you are doing a different application saying, yes, I know I owe so much, but I want to pay the principal tax in 1 or 2 months. Remember, we have barely 3 months to go before the amnesty expires. So that is the process. But if you have penalties only, you did not file a return, it's a nil return, I will urge you just to go file the return. The penalties and interest will automatically disappear.
So only 3 months to go, yeah? Okay.
Yes, three months and a few days, and maybe 20.
Some of us will have the time.
3 months, 18 days, yes.
3 months, 18 days to be specific. Okay,
yeah.
But roughly there. So Simon also asks, previously there was a tab on iTax profile where you just input your data and the annual pay automatically populated itself. Was this deleted? Maybe just clarify that.
Maybe it's something I need to revisit. Allow me to look at it with our iTax team, what changed. But again, we are also alive to a lot of changes in how people work, in the rates of tax. And that's why continually, every now and again, we enhance the pay return just to accommodate the different business models and to make it much more user-friendly. But I can come back with a response to that, yeah.
Okay, so we will get back to you on that. We'll for sure send you an email with responding to all the questions that you have right after this presentation. Moving on to YouTube, I can see there's a team from KRA who are responding to some of the questions, so that's great. I'll go to the ones that were not answered. So Shalel Kisianan, thanks for joining in the live. He asks, for purposes of determining SHIF and housing levy, kindly explain what constitutes gross salary.
Okay. I know there's been a lot of splitting of hair on what is gross salary, but you go back to gross salary with respect to the Employment Act. So any amount that you receive as part of your salary, excluding the what is the Income Tax Act. You know, people also confuse the gross salary and what is the Income Tax Act. Remember, it's a SHIF Act. So you look at the gross pay in the eye of the SHIF Act. So non-cash benefits will not feature there, but all other payments that you receive as an employee, you will actually be subjected to SHIF, will be subjected to affordable housing levy. And remember, affordable housing levy is also paid by even non-residents who are paid salaries from Kenya. Okay? But if you have any unique case, as I've already mentioned, you can always write so that we guide you properly.
All right. I think you've answered that conclusively. I'll jump to LinkedIn. I see Caroline Mwangi with another question. She asks, what of severance pay due to redundancy? That includes the 1 month notice. Assuming the employee will be paid in lieu, how is tax calculated in such a case?
Yes, payment in lieu of notice will be taxable in the month in which it is paid. So if you get payment in lieu, in that month it is paid, put it together with any other salaries and tax it. And I think I demonstrated that in my example. When I share the example, you'll actually look at it. You'll see how it is computed.
Yeah, so one thing, we'll definitely share the presentation to everyone who signed up on email. So in case you did not sign up, maybe you just joined directly from LinkedIn, drop us your email, and then we will add you to the list, the mailing list, once we send out the presentation. I can also see some comments. John Miner, hey, he says he's learning. That's on LinkedIn. Now this this is an interesting one. Daniel Wahome, he says, why would KRA require e-teams from a consultant? Consultancy fee is merely charge rate for service, which may not necessarily include expenses. I can sense the tone and he had when he was asking the question. So tell us, why would KRA require e-teams from a consultant, Nixon?
Yes, Daniel, sometimes we want to run away that we are not the ones who make the law, but our representatives make the law, which is Parliament. So if you look at Section 23A of the Tax Procedures Act, it is very categorical that if you are doing any business, and consultancy is actually business. If you go to Section 2 of the Income Tax Act, it says business means trade, manufacture, profession, which is also part of consultancy. So it says if you are in business, you are supposed to issue an e-teams compliant invoice, except for the exclusions that I've stated in that section, import of services or goods, for banking, some of those banking services, payment of salaries, those ones are not subject to e-teams. But the law requires that every person doing business must issue an invoice. And so consultancy is a business. You have to issue a e-teams invoice. Remember, e-teams invoice is not a tax. I think that is what sometimes really confuses people. Somebody hears e-teams and he says, this is a tax. No, it is an invoicing tool. So it's even good for you, by the way. Really, if you sent Nixon to go and buy for you a spare part in a certain shop, how will you tell that I've bought the spare part from that shop? I can come up with a fake receipt. But with e-teams, you can actually check the code and verify that the shop you had sent me is the one that I've bought from. So e-teams is not just for the taxman alone, it's also for business people. It's a good tool. Of course, whatever teething challenges that are there that are being addressed, but it's just an invoicing tool. And I hope that that should calm down, Daniel.
Nixon, you'll have to forgive us, but we've gotten to a point where everything is being taxed, man. So, yeah, it's easy to confuse e-teams as tax. Anyway, let me not get into it. I want to keep my job. So anyway, we also have a question again from Caroline. Hey, thank you, Caroline. You're a very active participant. We like it. So she also asks regarding the consultancy, is there a time frame for one to be a consultant in a company? Tell us.
I'm not a lawyer, but we always told that we'd never interfere with contractual agreements. What we do is to place tax in the contractual agreement. So if you have a contract with the company to be a consultant for 2 years, we'll not interfere with that. The challenge will be where the contract looks like an employment contract and not a consultancy contract. Then now we'll say, then there's issue with the substance in this contract. It is not consultancy. So I think key is how you contract, but we cannot dictate to you how you contract and what period and your terms, because that is private affairs, basically. Yeah.
Yeah, and I think you did a good job in really outlining what constitutes like a consultancy as opposed to like an employment. So
Sure.
Thank you for covering that. Shalel from YouTube. He asks, if my monthly salary is 80K, but in a particular month, my gross pay goes up to 100K as a result of 20K leave allowance, which is not a regular payment. How do we determine pay given that irregular payments are not chargeable to SHIF and housing levy? I think that's a really good question.
It is a good question. This confusion must have occurred in the affordable housing levy that was declared unconstitutional. That is the time that KRA gave guidance that if the payments are irregular, then it's not subject to AHL, the Affordable Housing Levy. But now with the Affordable Housing Levy Act, there is nothing regular or irregular. So long as you are earning gross pay from your employer, it will be subject to affordable housing levy, 1.5%. Shift is not even there. Okay, so if in 1 month you're earning 100K, in February you get your leave pay, which goes to 180, it will be subject to affordable housing levy in total.
Oof. Okay. Well said, Daniel. Because I think I want to rush through. I want to at least make sure everyone is answered. So allow me not to comment and just go to Daniel Musyoka. He says, just to take you back to NSSF Tier 2, some tax consultants advise that it is not mandatory as long as you have a running pension scheme. Please comment.
Billy, can you allow me to not to comment on that, to leave it for NSSF? So that I don't masquerade as a pension expert. Yes,
Okay.
I think maybe with NSSF we can reach out to them, get clarity from their end. But I think it's also important to look at, is it the third schedule to the NSSF Act? It will demonstrate to you whether there's any exemption. So I don't want to explain what I'm not sure about. Thank you.
Okay, no problem. So I think on part 2, we should bring NSSF team on board. All right. So Will Fresher asks, I think maybe you answered this in part, but just clarify. Can a director fee subjected to statutory deduction, or you can just withhold the 5% and that's it?
We've agreed director's fees is a salary by any other name. So put it together in the month in which it is paid and tax it under pay rules. Actually, there is a guideline that KRA gave back in, it must have been 2008 or 6, thereabout. Sometimes directors' bonuses are not automatic. Sometimes they have to be declared once the year is ended. So the guidance we have is that if directors' fees and bonuses are to be declared, the payee must be paid latest 4 months after the end of the accounting year, or in the month in which they are declared. But the latest is by end of the 4th month after the end of accounting year.
Awesome. All right. Jumping on to LinkedIn, Brenda asks, could you shed more light regarding the taxes on pension for those retiring before December? Okay.
Billy, December which year? In December, we might be having December 1990.
Come on, Nixon.
Maybe she could explain December which year?
December which year? Okay.
Yes.
Brenda?
If it is December 2024, they will be taxed according to those old rules. But any pension payment subsequent, then we'll get the favorable treatment currently.
Oh, okay. Okay.
So if you retire in 1990, but you are still getting your pension income, effective December 2024, that income will not be subject to tax, provided your retirement is in line with the exemptions under paragraph 53 of the first schedule.
Okay. So it's 2 more questions. I see we have 2 minutes, but we'll just take the remaining questions. Don't worry, we'll answer the questions that have been asked. I'll jump to YouTube. Mudoni asks, is what tax required on interest paid to an external lender? What tax
that
is required?
Withholding tax. It's withholding tax.
Oh, sorry. Yeah.
Sorry. Yes. So if you are paying interest to a foreign lender, the withholding tax is 15% on the interest you are paying to the foreign lender. If we have a treaty with the country of the foreign lender, visit the double tax avoidance agreement so that you are guided as to the exact rate. But what I know is most of the rates are about 15%. So yes, there's a withholding tax.
All right. Okay. So the last 2 questions. Still on YouTube, what constitutes an individual contractor agreement? Is this also deemed as tax evasion?
I'm suspecting Wanjiko might be a lawyer in terms of what an individual contractor agreement. what I read from here, Pili, is that we can contract. For example, Nixon can contract with HRBOX. That has individual contractor agreement. But the substance of our contract is what will detail whether it's an employment contract, which we call employment, is it a contract for services, and a consultancy contract, which is an employment for service. Okay, maybe I might be interchanging the two. So key is, what is the nature of our dealing? The contract might be there, but is the contract for consultancy or is for employment? If you are masquerading the contract, you are masking the contract as for consultancy while it is for employment, that is actually tax evasion. And we can charge you with respect to Section 83, double the tax. So officers might be lenient, but sometimes if that is found out, then yes, it is a rife case for tax evasion or avoidance.
Okay, so the last question. Okay, please explain. I think you mentioned this, but maybe you can just clarify. Please explain who is required to issue ETIMs. I think this is.
I want to draw our listeners' attention to the many documents, many podcasts, YouTube videos that has been issued by KRA. You are able to get all those who are required to issue ETIMs. But the short, so long as you are doing business in Kenya, you are running a kiosk, you are running a big company, you are running which top 40, under 40, so long as it's a company, the Safaricom's of Kenya, you are supposed to issue ETIMs when you are invoicing. So ETIMs is an invoicing tool. So long as you are invoicing somebody, you are invoicing the county government, you are invoicing HRBOX, you are invoicing KRA, then you have to issue an ETIMs invoice.
All right. So basically, you've mentioned almost everyone there, but we will oblige. We will oblige. So thank you so much, Nixon. I think we've come to the top of the hour. In fact, we have extended by 2 minutes, so our apologies for that. But let me just repeat: if you had not signed up through the link and you had just registered Pale LinkedIn and you'd like the presentation, drop us your email. We'll be sharing the presentation that Nixon has just made to you. And then if you have any question that has not been answered, whether it's regarding this or payroll, pension, please also drop them in the email or in any of our chat sections. You can find us Pale LinkedIn. We'll make sure we provide the right answers to you on your emails. All right. All right. So with that, we've come to the end of the session. Allow me to thank KRA and Nixon for leading us in such an informative session. I'm pretty sure just by the engagement, people will be here demanding for part 2. Will you come? When we ask you to come and
always available. Always available.
Good to know. Good to know. So thank you so much. And for anyone who's watching, if you're looking for a people solutions partner that is software, HR software, and HR services, please reach out to us. HRBOX Africa is our website. You can sign up for a demo or a call, or even on LinkedIn will be available. So with that, allow me to bid you goodbye, and we'll see you at the next one. Bye, guys.
Bye, and thank you.